What if I told you choosing the higher interest rate can actually make you wealthier? Not because the rate is better, but because your capital might be. If you're an entrepreneur consistently generating 18 to 20% returns inside your business, chasing the lowest mortgage rate could quietly cost you six figures over time. Let me show you the framework using a real Southlake property as an example. Today we're looking at 1075 West Dove Road in Southlake, nearly $5 million, over 7,000 square feet, luxury finishes, the kind of estate serious business owners and executives pursue. Now let's assume a 4.9 purchase price. Instead of talking about what's the lowest rate, let's walk through how sophisticated buyers think about this. Option 1, 10% down, about $500,000. Loan amounts just under $4.5 million. This is a 30-year fixed option around 6.5% on today's rates. Payments roughly $28.5 per month, and that's principal and interest. Yes, that's a higher rate. Yes, that's a higher payment, and that's where most buyers would focus on. But that's only half the equation. Option 2 can show you a lower rate by down and a higher down payment. So we're talking 20% down, which is about $1 million. Loan amount roughly $4 million. Now this is a 5-6 ARM around 5.5%. The payment drops to roughly $22,700 per month. Lower payment, lower interest expense, and it's cleaner on paper. So why would anyone choose option 1? Well, here's the framework. If you're a business owner earning 20% annually on reinvested capital, that extra $500,000 you didn't put into the house matters. At 20%, $500,000 generates roughly $100,000 per year. Now let's compare that to the additional cost of carrying the higher rate loan. The payment difference between the two options is about $5,800 per month. That's roughly $70,000 per year. So here's the spread. $100,000 potential business return minus that $70,000 of additional mortgage cost. That's about $30,000 positive leverage spread annually. That's the math. Sophisticated investors don't ask, what's the lowest rate available? What they ask is my internal return meaningfully higher than the cost of capital? If your mortgage costs 6.5% and your business reliably produces 20%, that spread is substantial. That's when the higher rate can make strategic sense because you're using debt as a tool and not as a burden. But here's the discipline layer. This only works if your 20% return is documented and repeatable, you maintain strong liquid reserves, the higher payment doesn't strain your lifestyle, and you understand leverage. It increases both upside and the risk. If your returns fluctuate or your margins are tight, then the lower rate, higher down structure becomes the intelligent move, because avoiding risk is also a return. On a property like 1075 West Dove Road, we're not debating small numbers. We're talking about a $500,000 capital allocation decision. Talking about $70,000, $100,000 annual swings. This is where mortgage structuring becomes capital strategy. And this is exactly the type of conversations top producing agents appreciate because serious buyers want clarity. They don't want rate quotes. At this level, we're not just qualifying income, we're aligning your mortgage structure with your wealth strategy. The takeaway here is that the higher rate is not automatically wrong. The lower rate is not automatically right. The correct answer depends on one thing. Is your rate of return on capital higher and more durable than the cost of your capital? If you're considering a luxury purchase in Southlake, Frisco, Prospero, Plano, anywhere in the North Dallas market, and you want to evaluate it through this framework and not just through a rate shopping lens, schedule a private mortgage strategy consultation below. We'll model both structures, stress test your return assumptions, and build the right decision around your real numbers. Because at $5 million, the mortgage isn't the product. Your capital strategy is. Be sure to like and follow for more content.